So in today's class, the adjustment that we are going to talk about is the taxation adjustment in the NPV format and the working capital adjustment in the NPV format. If you look at the NPV format, you can see sales revenue. Then from the sales revenue, you deduct the variable cost, and from that you deduct the fixed cost. You get the taxable cash flows. Taxable cash flows means the cash flow on which you charge the tax. Okay, and there you can see the tax adjustment that every year we are deducting some tax here. Uh, Here it is tax adjustment. Now, how do we calculate the tax? Let's understand that. Now, tax is charged on the net trading cash flows. Well, you know that whatever the business earns, they have to pay the tax on it, right? They have to pay the tax on it, and they pay the tax on the profits. They pay the tax on the profit. So, how do you calculate the profit here in this format? So, sales minus fixed cost and variable cost. Whatever the sales that you have generated from the project, from that you will deduct the fixed cost. Obviously, the relevant fixed cost. Okay, you know that we only consider the relevant cash flows minus variable cost, whatever the variable cost is, it will give you the net trading cash flows, and you multiply that with the tax rate. Net trading cash flows means, like the taxable cash flows, the cash flow on which you have to charge the tax. So let's say your sales for year one was $100, and your fixed cost was, let's say, $30, and your variable cost was, let's say, $20. So your taxable cash flows or net trading cash flows are 50. So on that 50, you have to pay the tax. You have to pay the tax. And let's say if the tax rate is 20%, so the tax payment is going to be 50 times 20%, $10. So that is the tax that you have to pay. So whatever the tax you need to pay, you will deduct it here, okay, from the format for each year, year one, year two, year three, and year four. Simple, no problems at all. Now, remember, if tax payment is in arrears, then if tax payment is in arrears, then the payment is shown in next year. Now, there are two types of the payment. Uh, there can be two types. First type is that for every individual year you pay the tax. For year one, you are going to pay the tax in year one. Uh, and the second type is payment in arrears, which means that for this year you are going to pay the tax next year. So year one tax will be paid in year two. Year two tax will be paid in year three. Year three tax will be paid in year four. Year four tax will be paid in year five. So that is payment in arrears. That you pay the tax of each year in the next year. Okay, you pay the tax of the relevant year, but the tax payment is done in the next year. So it means that when you will calculate the tax for year one, the payment you will show in year two. When you will calculate the tax in year one, the payment of that will be shown in year two. Similarly, year two's tax payment will be shown in year three. Year three payment will be shown in year four, and year four payment will be shown in year five. So we will add another section. Let's say if, the question was regarding the payment in areas. Have you both got this point?
Yes.
Post-tax cost of
Yes.
capital is used in taxation question. In the tax question, upon the cost of capital that will be given to you, you have to use the post-tax cost of capital. Cost of capital, means the rate, discount rate, right? The percentage. So for the taxation questions, you have to use the post-tax cost of capital that will be provided to you in the question. You have to use that to discount the cash flows, net cash flows, and then calculate the NPV. So that was a basic taxation adjustment. Now comes the main thing, main part, tax allowable depreciation. Now, you both have a bit of idea about this because you both have studied the financial reporting exam. There we talked about in the income tax standard that there is a way that tax department, there are, according to the tax rules, the depreciation charge is different, right? According to the accounting rule, it is different. Tax rules, it is different. So now depreciation simply in tax, it is known as a written down allowance. It is known as written down allowance, but the concept is same. Concept is same that you are reducing the value of the asset. You are reducing the value of asset. Either if you are using accounting method or taxation method, the concept is same that depreciation that we charge, which is known as a written down allowance or also referred to as capital allowance in taxation, is basically the depreciation of an asset that you charge. Okay. Now, that written down allowance or the depreciation, I am using the word depreciation so that you could understood the concept, because the depreciation means that you are reducing the value of an asset, reducing the value of an asset. Okay. Now, obviously in the project you will be like using different kind of asset, and there will be the depreciation or written down allowance of that. And on that allowance you get the tax relief, and on that allowance you get the tax relief. Now how does that work? Like, interesting. Now I will give you an example, and you have to focus on this example. Okay, if you have understood this point, you will understand the whole point. Now, depreciation expense, because of the depreciation expense, which is basically written down allowance in case of tax, does the depreciation expense reduces the profit or it increases the profit? Does expense reduce the profit or increase the profit?
Reduce.
Yes, it will reduce the profit. And when your profit will be reduced, you have to pay more tax or less tax?
Yes.
Less tax, yes. So it means that because of this written down allowance, because of this capital allowance, because of this tax depreciation, your profit will be reduced. Your profit will be reduced, and reduced profit means that you have to pay less tax, which means you are getting a kind of tax relief, which means you are getting a kind of savings, which means you are getting some kind of savings. And that savings we show, I told you in the last class as well, that savings we show as a cash inflow. Savings we show as a cash inflow. That is why here you can see that in WDA tax relief section, I have shown that as an inflow. Year 1 inflow, year 2 inflow, year 3 inflow. In year 4, it can be an inflow as well and can be an outflow as well. I will tell you how about the year 4, the last year. But the concept is that because of this written down allowance, because of this tax depreciation, your profit reduces. If your profit reduces, you have to pay the less tax. So it means that because of this allowance, you are getting the tax relief. Okay. Let's say for example, your sales was $100, and your other costs were, let's say, $40. So your profit was 60, and now you have to pay the tax on this 60. But let's assume now that there was written down allowance as well. So 100 your sales, 40 was your expense, and there was another expense of written down allowance of 20. So 40, 20. So now your net profit is 40. So now you have to pay the tax on $40. On $60, that you would have paid more tax, right? But on 40 you will pay less tax, so it means you are getting the kind of tax savings. So those tax savings are shown as a cash inflow in the main format. Okay, WDA tax relief. You can see here year 1, year 2, year 3, it's a cash inflow. In year 4 they can be inflow and outflow. I will explain to you how, but this is basically the concept. Have you understood this concept, tax allowable depreciation?
Yes.
This point that I have made. Okay. It is all okay. Now let me read from the notes. Also known as WDA written down allowance, and it is calculated by using either straight line method or reducing balance method. The same way as the accounting depreciation, you can use either straight line method or reducing balance method. Total tax allowable depreciation is cost less scrap value. So the total depreciation that you will charge with respect to an asset, it's equal to the cost less its scrap value. Okay, because from the cost, when you charge a depreciation at the end of the life of an asset, only scrap value is left, right? And for that you can sell the asset. So the total depreciation, the total allowance that you can charge will be equal to cost less scrap value. Okay, now let me write down example here, and I will try to explain it with an example. So let's say there is year and written down allowance and tax relief or tax savings. So there's an asset. Cost of asset is $1,000, and you charge the allowance on the basis of 5 years. Allowance or depreciation on the basis of 5 years, and let's say the scrap value of asset is 100, and we are using straight line method. So as per straight line method, what will be the what will be the depreciation of the asset for year 1 as per straight line method? What will be the depreciation? Cost is 1000, scrap is 100, life is 5 years.
Uh, could you please explain the on top part again? My meeting had got disconnected.
Which part?
The one before the tax, like when you were explaining the depreciation and expense and reduce profit after that.
Well, I said that depreciation is an expense and expense reduces the profit. So if expense reduces the profit, it means you have to pay less tax, right? So it means that because of this depreciation, you are getting tax relief, you are getting tax savings, and the tax savings are treated as cash inflow. So that is why in the format you can see that for the tax relief section, I have shown all of the figures as an inflow, except for the last year figure, year 4 figure. Okay. In year 4, it can be the inflow and outflow. How it can be inflow and outflow in year 4, that is what I will explain to you now. Okay.
Yes.
Now, the second thing that I was explaining to you, that how does this work. So for that, I have write down an example here, that let's say the cost of an asset is $1,000, life is 5 years, and the scrap value is 100. So tell me what will be the depreciation each year, or written down allowance.
180.
180. Cost less scrap value divided by the life of the asset. So 180 for year 1. Similarly, 180 for year 2, 180 for year 3, 180 for year 4, and 180 for year 5. So that is your written down allowance. Written down allowance means the same thing as depreciation. It's just tax allowable depreciation. The concept is of depreciation, but just according to the tax rules. Now,
So your screen is not syncing with your voice.
okay. Now let's calculate the tax relief. How do you calculate the tax relief? So whatever the written down allowance is, you are gonna multiply that with a tax percentage. You are gonna multiply that with a tax percentage. Let's say if the tax payment is at 20%, is it fine now, Preeti? Is it okay now?
I did you write anything, sir?
No, I write
In
tax at the rate of 20% here, and I write 180 written down
I
allowance
can
for each
see the
year.
20%. I can hear your voice, but the written down it's not visible.
So now how will you calculate the tax relief? So whatever your allowance is the amount by which your profit is reduced. So multiply that with the tax rate. So tax rate is 20%. So 180 multiplied by 20%, it will be equal to 36. So this will be your tax savings: 36, 36, 36, 36, 36. That's it. That is the tax savings that you are getting each year. How? Because this written down allowance, also known as capital allowance, also known as tax allowable depreciation, reduces the profit, hence it reduces the tax, and the amount by which it reduces the tax, that is gonna be your tax relief, that is gonna be your tax savings. Okay. Now, the point I have mentioned here is that the total tax written down allowance or depreciation is equal to cost less scrap value. Scrap value, like let's say here, the cost of an asset was 1000 and the scrap value was 100. So the total allowance, written down allowance, so the total depreciation that you could charge is equal to 900, which you can see. If you add all of these or you multiply 180 with 5, it equals to 900. So 900 is the total written down allowance on which you can claim the relief for the asset over its useful life. So that is how you do the working in case of straight line method. Clear?
Clear.
Yes.
Now the second point and really important point is in case of reducing balance method. You know how it works. In case of reducing balance method, in the last year of the project, we calculate balancing allowance or charge. This only implies, or this is only applicable if you are using reducing balance method of charging the depreciation or allowance. Now, for that, you have to calculate the balancing allowance or charge. For that, you have to calculate the balancing allowance or charge. Okay, now how does this work? Let's understand it. Understand this point. So I will just change this. I will Now we need to charge the depreciation. Let's say 20% reducing balance method. The rest it is same. Okay. Now you need to charge the depreciation or allowance according to the 20% reducing balance method. So what will be the WDA for the first year?
200.
200. And what will be the tax relief?
20.
200 times 20% will
Oh,
equal to 40.
40. 40.
So that will be your tax relief. Now for the second year, what will you do? For the second year, what's gonna be the written down allowance?
800 times 20%.
20%, 160, right?
Yes.
And what will be the tax relief? 160 times 20%, it will be equal to 32.
32.
Yes. Now I will tell you a shortcut. There is a shortcut which you can use, you both can use. Instead of, doing asset less all the allowance charge, multiply by the percentage and calculating WDA and then multiplying that with the tax rate to get tax relief. For WDA, because you are charging 20% reducing balance method, so multiply each year's WDA with 80% to get the second year's WDA. Now you multiply 200 with 80%, you got 160, right? Now you multiply 160 with 80%. Tell me what will be the answer?
128.
128. Now you can do it Purav in the other way as well. 1000 minus 200 minus 160 and then multiply that with 20%. See, you will get the same answer.
Yes.
So that's a shortcut. Similarly for year 4, multiply 128 with the 80%. So how much will it be? 128.
102.
2.4.
10.
2.4.
Okay, 102. Now, similar you can do for tax relief. Either you can multiply WDA with the tax percentage, or you can simply multiply this 40 with 80%, then 32 with 80%, and then the onwards. You will get the same answer. So, what would be the tax relief for year 3? 128 times 20% is going to give you 25 point something. How much is it?
26.
26. Okay, I'm going to write 26. Similarly, multiply this with the 80% or multiply 102 with 20%. You will get the same answer. So it is going to be 21.4, I think, right?
Yeah.
So I'm going to write 21 here. So you got the tax relief. Now I am not doing the working for year 5 yet, because in case of
Great.
reducing balance method, we have to calculate balancing allowance or charge in the last year. How do you calculate that? First one is investment net of already claimed WDA. Investment, what was our investment? The asset, the cost of asset was 1000, and how much of the WDA we have already claimed. So for this first 4 years, we have already claimed the WDA. For this, you can see that for these 4 years, WDA written down allowance, we have calculated the tax relief as well, tax savings as well. So what is the total of this 4 years WDA? Add it and tell me.
590.
590. So that is your net investment net of already claimed WDA. From that, you have to deduct the scrap value. What is the scrap value?
100.
100.
100. Okay, now tell me what will be the answer.
390.
310.
6, 410 and 100, 310. 310, right?
10. Yes.
So 310, because it's the positive, if the answer is positive, it's your balancing allowance. So in the last year, you are going to write 310, which is your balancing allowance. And now you will claim the tax relief on that. So 310 multiplied by 20%. How much is it? 62, I think.
62.
62.
Okay. So that is balancing allowance. Now look at the concept. You purchase an asset for 1000, and on the 590, you have already claimed the allowance. You have already claimed the allowance. Okay. You got the relief, you got the saving. You can't get relief on scrap value. You can't get relief on scrap value. Why? Because the logic is very simple. You are getting benefit by selling the asset. So why should the tax authorities give you relief on that? If you have an asset of 1000 and 200 you can get by selling it, at the end of the life. So you are getting the benefit by selling the asset, right? So tax authority won't say that, okay, very great, you are getting $200 benefit. Let us give you tax relief on that as well. Why? They won't, right? Have you understood this point? So that is why
Yes.
in the last year for reducing balance method, Preeti, we will see how much is our investment net of already claimed WDA, and from that we deduct the scrap value. Whatever is left, if it is positive, it will be known as your balancing allowance, and you will get the tax relief on that. Okay, clear?
Clear.
Now
Yes.
opposite. Let's go opposite. Let's say For example, let's assume that investment net of already claimed WDA, in this case it was 410, right? It was 410, and your scrap value was 500. It was not 100, it was 500. Now your answer is 90 negative, right? It's on the negative side. So now it is known as balancing charge. Now, in the balancing charge, the tax authority says, pay me the tax. Why? Because they will say that 410 is, your investment worth is 410 net of already claimed WDA. But you are getting the benefit of 500 on the asset. By selling the asset, you are getting 500. So on the extra 90 that you are getting, pay me the tax on that. Pay me the tax on that because you are getting more benefit, right? Because you're getting more benefit to, so pay me the tax on that. So in that case, you both will multiply this 90 with 20%. It will give you $18 negative. So here you will show that as negative $18, which will indicate that you are paying the tax. So for starting years, it's going to be balancing allowance, cash inflow. For the last year, it's going to be balancing charge, which is cash outflow. Any question you want to ask, you can ask.
No,
No.
So this is a very important concept and you should be aware of that. Okay. Now let's read these points, and then we will do a few examples of regarding this. Unless told otherwise, we assume that the asset is purchased on year zero and first tax allowable depreciation is given 1 year later at year one. Okay, we will. Our assumption is we purchase asset at start year zero, and the first depreciation or written down allowance is gonna be at year one. You can claim tax relief on written down allowance, and I just told you how do you claim that. How do you calculate tax relief? Whatever the written down allowance is, you multiply that with tax rate. And the last point, very important point, if tax payment is in arrears, then tax savings of the relevant year will be shown in next year in NPV format. So remember another important point. These are the small points, but you should remember these points because when we will practice the long question on Excel, I am going to ask you both these points. That if in case tax payment is in arrears, then the tax relief will also be shown in the arrears. So year one tax relief will be shown in year two. Year two's tax relief will be shown in year three. Year three tax relief will be shown in year four. Year four's tax relief will be shown in year five, and year five tax relief will be shown in year six in the main format. Is it clear? Is this point clear?
yes, sir.
Yes.
Okay, now let's attempt and let's do an example regarding this. So the example is in front of you. An asset is bought for 1000 10,000 and will be used in the project for 4 years, after which it will be disposed of. Tax payable is 30% 1 year in arrears. Tax allowable depreciation is available at 25% reducing balance method. So you charge the depreciation using the 25% reducing balance method. What do you need to calculate? Calculate the tax allowable depreciation and hence the tax saving. So you have to calculate tax allowable depreciation, which means WDA, written down allowance, and whatever the tax savings are for each year if the proceed on the disposal of the asset are 2500. So if the scrap value is 2500 and you are using 25% reducing balance method, you have to calculate each year's written down allowance and then the relevant tax savings. So let's start. Project life is 4 years, so let me write it down here. So year one, year two, year three, year four, WDA, and then the tax savings. Okay. So you know the cost of the asset is 10,000. You know the life of the asset 4 years. Tax rate 30%, and it's 25% reducing balance method. So tell me, okay, what will be the WDA for first year?
2,500.
Yes, 2,500. And what will be the WDA for second year? There's a shortcut I told you. You will
Times
multiply the 2,500 with the what percentage?
8. What is the percentage?
No, not in this 8 case 80. How much, Purav?
70%.
Well, it's
75.
it's 75. Why are you saying like 70? Like look at the reducing
Uh,
balance percentage. It is 25%. So it means you will reduce the WDA by 75%. It's a shortcut.
yes.
So 2,500 times 75%, what will be that
1875.
for year three?
1406.3.
For year 4, will we do the same?
No.
Because we have to calculate the balancing allowance or charge. So let's leave it. Let's calculate the balancing allowance or charge. So what was the formula for that? Investment net of already claimed WDA. So your investment was 10,000. And what is the total claimed WDA, the one that you have already claimed? Add all these three.
5,781.
5,781 less the scrap value. The scrap value is 2,500.
4,000.
How much will it be?
1719.
So it is a positive, so it means that it is a balancing allowance, and on balancing allowance, you get the tax relief. Okay, 1719. Now calculate the tax savings. Multiply the WDA with the tax rate, which is 30%. So 2,500 times 30%.
750.
And for the year 2,
525.
5.
25.
How did you calculate that?
5
750.
562. 563.
563. Pretty, it's tax savings. So if the tax rate is 30%, so you multiply the 750 with 70%, the left remaining percentage, not
It calculated with
not
70%.
not the reducing balance, because that is only relevant for WDA. The other way is to just multiply the WDA with the tax rate. 1875 multiply by 30%, you will get the same answer. For year 3
Mhm.
422.
and for year 4,
515.7. So 516.
516. You cannot multiply 422 with the 7% because its balancing allowance is different, right? So you have to calculate the tax accordingly. So if you don't want to get confused, you can simply just multiply WDA with the tax savings. Don't use the shortcut here, because then you can get confused in the balancing allowance or charge working. So that uh is it. That was your answer for the part A. For the part A, you have to tell what is the written down allowance and what are the tax savings. Now the part B. How would your answer change if the asset was sold for 5,000? If the scrap value was 5,000, how would the answer be different? Okay, now we have to tell that. So let's calculate. So if the scrap value was 2,500, so it means that in the last year, uh, 10,000 minus already claimed WDA 5,781. But in the last year, now we will deduct the scrap value by 5,000, right? So tell me what will the answer now?
Minus 781.
Negative 781.
Negative
781.
781. So this is your balancing charge. So you will multiply this negative in for year 4. You will multiply this negative 781 with the tax rate. What is that? 30%. So how much will it be?
25%.
234.3.
So 234 is the tax payment that you will show in the year 4 in the main format. Here in the last year, year 4, you will show this 234 negative. You will write negative 234, okay? Because it's a tax payment. And for year 1, 2, 3, whatever the tax savings that you have got here, 750, 563, 422, you are going to write it there. Clear? So that is what you are going to do for part
Yes.
B. Now let's do this part C. So what is the requirement? If net trading income, I means the taxable cash flows. I've already told you. Uh, is from the project is 8,000 per year based on your answer to part A. So now you have to take the figures from the part A, and if the cost of capital is 10%, calculate the NPV of the project. So now have to do working as per part A. Read this paragraph very carefully. An asset is bought for 10,000. Project life is 4 years. Tax payment is 30% in arrears. Written down allowance we have already calculated. For part C, we have to calculate NPV. So let's do that. So year 0, year 1, year 2, year 3, year 4. First of all, we write investment. And investment is how much? 10,000 negative. Then we write sales, variable cost, fixed cost, and the result of that gives us taxable cash flows, which are also known as net trading cash flows. I have just mentioned you that. But in that case, we are directly provided with that, so I can just write taxable cash flows directly. Taxable cash flows, taxable cash flows, they are 8,000 each year. So 8,000, 8,000, 8,000, and 8,000. And we have for the taxable cash flows, we charge the tax. We multiply these cash flows with the tax percentage. So let's calculate the tax. Tax will be at the rate of 30%. So tell me what will be the tax that you will show in year one?
2,400.
2,400.
Now you both of you, sh- the answer of the tax is right, but where will we show this year one's tax payment?
In year 2.
In year two,
In year
because
2.
tax payment is in areas. I don't know why, Purav, there's a distortion from your mic. I think it's your mic. There's a lot of distortion. So tax payment will is 20 is going to be 2,400, but year one's tax payment you are going to show in year two. So I'm going to write 2,400 here. And year two tax payment, where will you show that? Year three. Year three tax payment will be shown in year four. And in year four tax payment will be shown in year five. So I have to add extra year here. So I will write 5, 2,400 negative. Clear?
Yes.
And on the tax, if there's a tax and there's a tax relief as well, so you have to show that tax relief as well. So tell me, where are you going to show tax relief? We have already calculated that. You can see above in part different. So where are you going to show the savings? Tell me, what are the savings that you are going to show in year one?
Same
0.
in 2.
Zero. You are right, zero. Because if
Yeah.
tax payment is in arrears, the tax savings are also be gonna shown accordingly. Year one's tax savings will be shown in year two in year three, and year three tax saving in year four. So the first tax saving is of how much amount? 750. You will show that in year two. Then 563 in year three, 422 in year four, and 516 in year five. Clear?
Yes.
Anything else that we have to show for the last year? For the end, because project life is 4 years. So I will show you guys format again. See the format and tell me, is there anything else that we need to put here? Anything else?
The working capital.
There is no working capital in this part.
Scrap proceed.
Scrap value. The scrap is
Value.
what you need to show, because you guys should understand that we are talking about all the cash flows at the end of the life of the project. We will sell the asset and we will get 2,500. The life of the project is 4 years, so the 2,500 will be shown in year four. If you guys have any problem, you can ask me. Clear up till this point?
Yes.
Okay, now you will get the net cash flows. So for year zero, because there's only one thing investment, so 10,000. Then for year one, 8,000. Tell me what will be for year two.
6163.
6,350.
6,350. How did you calculate 6,163? Well, for year two, 8,000 minus 2,400 plus 750. For year three, it's
Six
6.
one
Okay, it's for year three, 6,163. For year four,
8522.
8,522. For year five,
Negative 1884.
okay, so cost of capital that is given to you is 10%, so you will discount at 10%. So discount factor is 10%. So at 10%, well, the discount factor, you should not memorize these. If for year zero, they are 1, 0.909, 0.826, 751, 683, 621. Okay, now calculate the present value, multiply. This will give you 10,000 negative. 8,000 times 0.909, how much will it be?
7272.
7272. Then for year 2,
5245.
5245. For year 3,
4628.
4628. For year 4,
5821.
and for year 5,
1172.
1884 times 0.621. How much is it?
1172.
1172 negative. Okay, because it's negative, not positive. Now calculate the NPV. Sum them all. Minus 10,000 plus 7272 plus 5245 plus 4628 plus 5821 minus 1172.
Positive 11,794.
So that is the NPV of the project. Clear?
Yes.
Yes.
So that was your tax working written down allowance working. Now, clear? Any question you wanna ask, you can ask.
Those
No.
Okay. So now let's move on to the second working that we have to discuss in today's class. That is the working capital adjustment. Okay, working capital adjustment, and it's probably the last. Well, it is basically the last working if you look at the format, because in the format like we have covered everything. Only this working capital is left. So now let's understand what is this adjustment. Okay, so working capital. Well, you guys have done management accounting, so you will have an idea about working capital. The formula, at least, it's current asset minus current liability. And when you invest in the project, you initially you do an investment. Let's say you purchase an asset, that's your investment. But afterwards, or you need more investment in the project to support the operational activities. Like, if you invest in something, it does not mean that, okay, the initial investment is all that you need to spend. No, for the operational activities, you have to spend some amount, right? You need to spend something to support the operational activities during the life of the project. So that investment in the new project, the investment that we do, additional investment to support the operations, is known as working capital investment. Okay. So that in additional investment that we do to support the operations is basically the working capital investment. Now, working capital formula is current assets minus current liabilities. Current assets are those assets which are realized within 1 year. Like, let's say if you have a receivables, so you know that you are gonna get cash uh, from the receivables. Ideally, you should get the cash from receivables within a year, right? Similarly, payables is your current liability. So the current liabilities are the liabilities that you will be settling, that you will settle in 12 months. Like payables, if you have payables, so ideally you should settle that payables within 1 year. So the assets that are realized within 1 year, they are current assets. Liability which are settled within 1 year, they are current liabilities. Okay, clear? So the next point,
Yes.
this point, third point is really important. Working capital investment should be recovered within 1 year, ideally. That's a really important point. That when you spend something in working capital, when you invest something in working capital, ideally, because everything settles within a year, you should get back your investment as well. You should get back your investment as well. Let's say you purchase an inventory on credit, so there will be a payables. Now, using that inventory, you will produce the product, and then you will sell the product, and by selling the product you will get the cash, right? It will convert into the receivable, and then you will get cash. So ideally we assume that when I invest something in working capital, I will recover that within an year. Clear? Is this part clear?
clear.
Yes.
So it means that when I invest in the project, the initial investment is done. Then I will invest something in working capital today. So I will assume that I will recover that in year one. Similarly, if I spend something in year one, I will assume that I will recover that in year two, right? Ideally, it should be like that. For year two, whatever I invest, I will get that back in year three. So this is the point that you need to understand. Now comes the main part, that how you reflect, how you show the working capital in the format, the NPV format. That is the important thing. So there is the pro forma in front of you. Like, let's say the life of the project is 3 years. Now, in the beginning, when you invested in the project, okay, one more thing. Remember that initial investment in the working capital is shown as a cash outflow in year zero, because that is the time when you invest in the working capital. Let's say you invested in the project now, and to support the operations of the starting year, you spent something on the working capital. You spent something on the working capital. So $100 is what you have spent on the working capital, or you can say you have invested in the working capital to support the operations. So for year zero, your working capital will be shown as negative 100. Okay. Now in year one, to support the operations of year one, Preeti, you invested 100 more. But the previous year 100 investment, I told you ideally it should be recovered in 1 year. So you will recover that in year one. So you need $100 to be spent in year one, and you got $100 return that you spent that you invested in from year zero. So the net impact is zero. The incremental incremental investment that you need to do is zero. Have you got this point?
Yes.
Preeti, have
Yes.
you got this point?
Yes.
Okay. Similarly, to support the activities of year two, you need to spend $100 in working capital. But you will recover year one's working capital in year two because you recovered in 1 year time. So again, the incremental working capital is year zero. And for the last year, you need to spend $100 to support the operations of the year three. So in the last year, for the last year, obviously the years two working capital, you will recover it, you will get that back, and you don't need to spend any more because the project is over now. Because that's the last year, right? Last year means the project is gonna over, so you don't need to spend any extra thing. The years two working capital, you will get that back, and it will show as a positive 100. Why it is positive 100? Because you don't need to spend anything in the last year. Okay, by the end of the last year. Have you got this pro forma?
Yes.
Have you both got it, Purav?
So the positive amounts on top, what you are spending, and the
So
negative
in the
amount
last
is
year, you don't need to spend. In the end of year three, you will get back the previous year's working capital because it's the last year project is done and dusted. So you don't need to spend anything.
yeah.
Okay.
Okay.
Look, the thing is, whatever you spent in year zero is to support the operations of year one. Whatever you spend in year one is to support the operations of year two. Whatever you spend in year two is to support the operations of year three. Now in year three, you don't need to spend anything because there is no year four. The project is over. So in the last year, you will just recover the previous year's amount and it will be shown as a cash inflow. Okay.
Yes. Yes.
So minus 100 will be the incremental working capital in year zero, and then the last year it will be 100, and the net impact is zero because what you spend, you get it back. Okay. That is the working capital stuff. Now, the next point is very important. Working capital should be adjusted for inflation. If there is an inflation, you need to adjust the working capital accordingly. And that the point after this is, if the sales of the company increases, the requirement of the working capital will also increase. And if the sales will fall, the need of the working capital will also fall. It's a very common sense based thing that if your demand is increased, you have to sell more units. It means you have to spend more cost on the operational activities. So the requirement for the working capital will increase. Now let's say for year zero, your working capital was 100. But for year one, the amount that you need to spend is 110. Now, from the last year, Purav, how much will you recover? 100, right? And for this year, you need
Yes.
to spend 110. So your incremental working capital would be $10. 110 minus 100, $10. So it means you need to spend 10 extra. Incremental means the additional that you need to spend. Okay. Got my point?
Yes.
Similarly, Preeti, if year two working capital requirement is $120, how much will you get from the year one? 110 that you spent. So the net amount, that the additional amount that you need to spend will be $10. Got it?
Yes.
So if there is an inflation, as you inflate sales, as you inflate the cost that we did in the last class, similarly, you have to inflate the working capital as well. Similarly, you have to inflate the working capital as well. And whatever the incremental amount is, that is what you show in the format. So when I will prepare the format, Purav, I have to show these workings in the format, the pro forma, the main format of NPV. How will I do that? I will calculate these separately in separate working, and these figures, minus 100, 0, 0, 100, that is what I need to show in the format here. You can see here. You can see for the working capital, cash outflow, year one, year two cash outflow, year three cash outflow, and in year four, it can be cash inflow as well. So this is how it works. So now let's directly understand this with the examples. Okay, so there are two examples. Okay, please read this example. Purav, you can read this example.
A company expects sales for a new product project to be 225,000 in the first year, growing at 5% per year. The project is expected to last for 4 years. Working capital equal to 10% of annual sales is required and needs to be in place at the start of each year.
Okay, so you need to
Calculate the working
calculate.
capital.
Yes, you need to calculate the working capital figures that you have to put in the NPV format. Now here the working capital is equal to 10% of annual sales. So it means that we have to calculate the sales, right? And he have the in the question it is mentioned that the sales are 225,000 for the first year, and then they will grow 5% each year. So the first year sales, well, it's gonna be 225,000. Tell me what will be the sale for year two. It's growing 5% each year.
236250.
For year three,
472,500.
no, you have to grow it by 5%.
248,062,062.5, so 63.
248063, and for the last year,
260,465.6.
so 260466.
260,466.
Okay,
Yes.
466. Now let's do the working for the working capital. 3, 4. So working capital required each year. Working capital required each year is 10%. So for year one, the working capital is 10% of the sales, right? So 225,000 times 10%, how much will it be? 22,500.
Yes.
So I told you that the initial investment is done at year zero, and you have done that to support the operations of year one. Okay. This point is clear to you both, like you invest to support the operations of the next year. Is this
Yes,
point
yes.
clear? Okay. So incremental working capital for year zero is going to be the same 22,500 negative. Now for year one, what will be the requirement? uh, how much will you invest in working capital for year one? The amount that you will invest in in year one is to support the operations of year two. So it means that 10% of these is the sales of year two. We know whatever the sales is, 10% of that is what you need to put in the working capital, the amount that you need to put. So that is what you are going to put in year one. I told you that 1 year prior to you do that. So how much will it be? 23625.
Two three
2362.
23625.
Okay. And what will you recover in year one? How much of that, how much of the working capital will you recover in year one?
22,500.
Yeah.
Yes, 22,500. So it means that the previous year one you will get here, get in this year, and the additional is what you need to spend, because that is you will get that from the last year. So what is the incremental additional that you need to invest? 23625 minus 22,500.
1125.
11 to 5 I will show in the bracket, Purav, because that is the additional that I need to put. That is the cash outflow, right? That I need to invest. So don't get confused that if my answer is positive, so it will be positive. No, that is the working capital. Working capital means investment, which means cash outflow. What will be the requirement for year two? The working
Uh,
capital requirement?
24806.
24806. How much will you recover?
23625.
So what is the additional that you need to put in year two?
1181.
Okay, what will be the requirement in year three? 2604.66, so 26047. How much will you recover? 24806. So what is the additional that you need to put?
1241.
1241.
Okay.
And in the last year that you spent in the third year, 2647, you will just recover it. You don't need to put anything
Yeah,
because there is no year five.
last year.
So 26047. Now these figures that you have got, 22,500 negative, 1125 negative, 1181 negative, 1241 negative, 26407 positive. These are the figures that you are gonna put here. Now here, for the working capital, I made a mistake. I did not show that here in year zero. It's also in year zero here. So I will adjust these notes, okay? Year zero because you invest in year zero. So that is how working capital investment is done. Adjustment is done. Is this clear to you both?
Yes.
Now, please add the total amount
Yes.
that you spent on the project in respect to working capital, the total amount, uh, uh, all of the investments for every year, 2 to 500 plus 1125 plus 1181 plus 1241. Please add all these. Tell me what the answer is. What the answer?
26047.
So the total investment that you over made over the life of the project in working capital was 26047. And Purav, you get all of that back in year four at the end of the life. And I told you that working capital gets recovered. So whatever you spend, ultimately at the end of the project, you are gonna recover everything. It's just that you have to show the split in the format. I hope this is clear.
Yes.
Yes.
Okay, now let's do this last part and finish the class. Please read the requirement. The question, sorry, requirement is to calculate the working capital question. Preeti, you can read it.
A company anticipates sales for the latest venture to be 100,000 units per year. The selling price is expected to be $3 per unit in the first year, inflating by 8% per year over the 3-year life of the project. Working capital equal to 10% of annual sales is required and needs to be in place at the start of each year.
Okay. So again, the sales units are given to you and selling price is given to you for the first year. And it's mentioned that it will inflate by 8% over 3 years life of the project. So sales will increase by 8% every year. Working capital again is 10% of the sales. So we have to calculate the sales for each year. So let's calculate that sales for year one, year two, and year three. Year one would be 100,000 times three, 300,000. And now you can simply inflate these. So by 8%. So what will be the sales for year two? 3 8s are 24, so 324,000.
For those
And for
320.
year three, well, why are you guys taking so much time? Just multiply this with 1.08. Simple. 324,000 times 1.08.
349920.
You should not take that much time in this. It's just a basic thing. You just multiply the previous years with the increase, like 1.08. Or the other formula I told you, 1 plus inflation rate divided by power n, that one that you can also use. So anyways, that's the sales. So let's calculate the working capital. So working capital requirement in year zero, how much do you need to invest in, what is the requirement in year zero? Working capital is equal to 10% of the sales, and in year zero you will invest that is required to support the operations of year one. So working capital for year one is 30,000, but you will invest that at the
30,000.
beginning in year zero, 30,000. I am repeating to you again and again that you make an investment prior. Like if the sales is going to happen next year, so whatever the amount, not next year, but at the end of year one. So you need to invest that in year zero. So the incremental working capital is going to be 30,000. So what will be the working capital requirement in year one?
32,400.
32,400. How much will you recover in year one?
2,400.
how much we will recover? We will recover the previous year's working capital is 30,000. So the in additional amount that we need to invest in the working capital would be 2,400. For year two, what will be the requirement? 34992. And the recovery will be of the last year, 32,400. So what is the additional amount that you need to put in the working capital? How much is it?
2592.
2592. And in the last year, you will get the recovery of three. There is no requirement. It's just that you are gonna get recovery. So 34992 is your recovery. 34992. So these are the figures that you are gonna put in the format of NPV. These are the figures that you are going to put in the format of NPV. Negative 30,000 you have to show in year 0. 2,400 negative you have to show in year 1. 2,592 you have to show in year 2. And 3,499 positive in year 3. Is this clear?
Clear.
Now we have done the inflation adjustment. We have done the taxation adjustment. We have done the working capital adjustment. We have practiced questions for each adjustment. And now in the next class, we are going to practice the past paper questions on the Excel on how to prepare the NPV. So I want you both to revise these adjustments before tomorrow's class so that you should have an idea that like what we are doing, okay, while practicing the question.